Okay, so let's unpack this. Imagine you're driving down the highway,
Okay, I'm with you.
and the digital dashboard in your car says you're cruising at a comfortable, perfectly legal 30 miles per hour.
Huh?
You feel great about it.
Right, nice smooth ride.
Exactly. But then you look out the window,
Yeah.
and the trees are just flying by at 100 miles an hour.
Oh, wow.
Yeah, you're white-knuckling the steering wheel, completely terrified while the dashboard just keeps blinking that everything is totally fine.
Yeah, that's a terrifying visual.
Right. And that exact feeling, that total disconnect between the official gauges and the terrifying reality outside your window,
Yeah.
that is exactly what it feels like to buy a house right now.
It really is a profound disconnect because, I mean, we are all taught a very linear, comforting version of economic gravity, right?
Right, like a basic Cretan effect.
Exactly. When the central bank drops interest rates, the cost of borrowing goes down, and suddenly, magically, it becomes cheaper for you to buy a home.
The gauges look good, so the ride should be smooth.
Precisely. But as anyone who has actually walked into a bank recently knows, that gravity seems to have just stopped working.
Which is why you are not crazy for feeling frustrated right now, and you are definitely not alone. So welcome to today's Deep Dive.
Glad to be here.
We're pulling today's data from a fascinating March 2026 report by Jamaica Homes News. And our mission today is to answer the exact question that is probably driving you up the wall right now.
Which is, why are central bank interest rates dropping, but your mortgage is still painfully, stubbornly expensive?
Yes, we're looking specifically at the Jamaican housing market today, but frankly, what is happening there is like a perfect, compressed microcosm of the friction between global economic headlines and, your local bank account.
It really is the ultimate case study in reading between the lines, because if you just read the top-level numbers, you would think the market was entering this golden age of affordability.
Right, because the headlines look great.
They do. In early 2026, the Bank of Jamaica, the central bank, actually cut its policy rate to 5.5%.
Wow, okay.
And on paper, average mortgage rates have held steady around 7.5% for over a year.
Right. So you read a headline that says central bank cuts rates to 5.5%, and you think, well, fantastic. The inflation storm has passed. Time to go house hunting.
Exactly.
But then, so imagine you walk into a commercial bank in Kingston right now. You have a good job. You have great
Or
credit.
the ideal candidate.
Right. You sit down across from the loan officer. You ask for that 5.5% rate you just saw on the news, or even that 7.5% average. And the loan officer is going to look at you, smile, and hand you paperwork for a mortgage at 11%.
Or maybe even 12%.
12%. I mean, that is the moment the dashboard completely detaches from reality.
It really is. The actual lending rates that everyday people are facing are sitting squarely between 9 and 12%. The commercial lenders are simply not passing the central bank's rate cuts down to the retail level.
I have to push back on the mechanics of this, though, because
Yeah.
to the average person, it feels like outright theft.
I can understand why it feels that way, yeah.
I mean, if the central bank drops the cost of money, shouldn't my mortgage immediately become cheaper? It's like the global wholesale price of coffee beans dropping by half.
Okay, I like this analogy.
Right. But your local cafe still charges you the exact same $8 for a latte. Their raw materials got cheaper, but they just kept the difference to pad their own pockets instead of passing the savings on to you.
That is a highly accurate way to look at it, actually. But we have to understand the why behind the cafe's decision. What's fascinating here is the mechanical difference between monetary policy and retail banking behavior.
Okay, break that down for me.
Well, the central bank sets the tone. They determine the base cost of money to stimulate or cool down the entire national economy. But commercial lenders, they are independent, profit-driven entities managing their own incredibly localized risk.
So they're hoarding the savings because they're scared, or are they just greedy?
It's a mix of risk management and profit protection. After a long period of global economic uncertainty and tightening, lenders are holding on to that spread.
The spread being
A cushion between the 5.5% they pay and the 11% they charge you.
Got it.
They look at the landscape and decide that maintaining a thick profit margin is safer for their balance sheets than offering cheap loans to the public. They absorb the rate cut, they just don't distribute it.
Which creates this bizarre environment where the market is technically stable.
Mm.
Because the rates aren't wildly fluctuating up and down every single month, which is, what economists mean by stable.
Right.
But stable absolutely does not mean easy.
Precisely. Predictability is great for a bank's spreadsheet, but a predictable 11% is still brutal for a home buyer's monthly budget. And this high-rate environment makes the commercial lending space incredibly subjective.
Subjective how?
Because the rates are so high, the bank is hyper-focused on whether you can actually carry that heavy burden.
Oh, I see. Which means they start looking for literally any reason to deny you or to charge you even more to cover their risk.
Okay. Exactly. The approval process and the final weight you actually secure suddenly depends heavily on factors that feel deeply personal. Your income stability, your employment history, and crucially, your existing banking relationships.
Wait, banking relationships, you mean literally just how long I've had a checking account with them?
Yeah, think about it from the bank's perspective. If they are going to hand out a massive loan at 11%, they want absolute visibility into your cash flow.
Right, they want to know you're good for it.
Exactly. If you've been banking with them for 10 years, they see every paycheck, every grocery bill, every utility payment. They know exactly how you behave with money.
So you're a known entity.
Right. But if you walk into a brand new bank off the street, you are a complete unknown. Two applicants with the exact same salary and the exact same house in mind can walk into a bank, and the one with the 10-year relationship might walk out with a 9% rate, while the stranger gets slapped with a 12% rate.
That is wild. I mean, we are talking about a 3% difference on a 30-year mortgage
Yeah.
just because of where your direct deposit goes.
It's huge.
That is hundreds of thousands, if not millions, of Jamaican dollars over the life of the loan. It really proves that the average headline rate is just a total illusion.
It really is.
But, this brings up a massive glaring question. If commercial banks are holding rates at 9 to 12% and making you jump through all these behavioral hoops just to get those terms, how is the average person supposed to afford a house in Jamaica right now?
It's a very fair question.
Because if I'm doing the math on an 11% mortgage for a modern family home, the monthly payment is going to completely wipe out my entire salary.
It would wipe out most people's salaries, absolutely.
Yeah.
And if that were the only option, the entire housing market would simply freeze. Nobody would buy anything.
Right.
This is where we have to look at Jamaica's unique structural solution to this exact problem. Because the anchor of affordability in this market isn't a commercial bank at all. It is the National Housing Trust, or the NHT.
Okay, here's where it gets really interesting. Because I was looking at the numbers for the NHT, and it feels like we just teleported to a completely different economic reality.
It really does.
We just talked about commercial rates choking people out at 11 or 12%, but the NHT offers mortgage interest rates ranging from 0 to 5%.
Yep.
0 to 5. How on earth is an institution lending money practically for free when the banks right next door are charging 12%?
Well, because the NHT operates completely outside the gravity of commercial banking. It's a public entity fundamentally designed to facilitate homeownership, not to maximize quarterly profits for shareholders.
So they don't have the same profit motive.
Not at all. It's funded by mandatory payroll deductions from the Jamaican workforce and employers. So it is essentially a massive collective pool of contributor funds.
Oh, I see.
Because it is subsidized by the workforce itself, it can afford to lend that money back to eligible contributors at those rock-bottom rates of 0 to 5%.
Okay, my immediate thought here is pretty obvious. Why doesn't every single buyer just use the NHT for the whole house and ignore the commercial banks entirely?
Oh, everyone wishes they could.
Right, because if I can get 2% at the NHT, I am never walking into a commercial bank again. There has to be a catch.
The catch is the loan limit. The NHT is a public trust, so it has to spread that money around to as many contributors as possible. They cap the maximum amount you can borrow. And in a market where property values have steadily risen, a standalone NHT loan is rarely enough to cover the full purchase price of a home, especially in urban centers or for a modern family house.
Okay, so the NHT gives you the cheap money, but they cut you off before you reach the finish line.
Exactly.
If the house costs $30 million, the NHT might only give you a fraction of that at 2%. So you're forced to go back to the commercial bank to make up the difference.
That's the reality. And this forces buyers to create a very specific financial cocktail. They blend the public funds with the private funds. Let's do the math on how this actually saves the buyer.
Yeah, let's hear it.
If you took out a $30 million loan entirely from a commercial bank at 11%, your monthly payment would be absolutely crushing.
Yeah.
But if you get a chunk of that financing from the NHT at 2% and only take out a commercial loan for the remaining balance at 11%, you blend your overall effective interest rate down to something much more manageable.
So it averages out.
Exactly. Maybe your blended rate ends up being 7 or 8% instead of 11.
It dilutes the poison of the commercial rate.
That is the perfect way to phrase it. And if we connect this to the bigger picture, what becomes abundantly clear when you look at the data is that without this dual system,
This blending of loans.
right, this specific hybrid of public support acting as a shock absorber against private lending homeownership would be a mathematical impossibility for a huge portion of the population.
Well,
The NHT isn't just a nice perk for buyers, it is the absolute load-bearing pillar of the entire Jamaican real estate market.
okay, so let's say I'm the buyer. I played the game perfectly. I used my NHT benefits. I blended the rate with a commercial loan, and I hacked my monthly payment down to a number I can actually survive on a month-to-month basis.
You're feeling pretty good.
I'm feeling like a financial genius. I am ready to move in.
Well, not so fast.
Uh-oh.
Getting the monthly payment down is only half the battle. In fact, for many buyers, it's actually the easier half.
Wait, really?
Yeah, because the true roadblock, the massive concrete wall keeping people out of houses right now, isn't the monthly interest rate. It's the sheer, overwhelming amount of upfront capital required before the bank will even let you sign the paperwork.
The deposit wall. This absolutely blew my mind when I looked at the actual figures in the report. We talk so much about monthly rates, we completely forget about the barrier to entry. Buyers are typically required to put down 10 to 20% of the property's value as a deposit.
Let's ground that in a real-world example. Say you are looking at a reasonably priced modern home for 30 million Jamaican dollars. A 10 to 20% deposit means you, the buyer, need to produce between $3 million and $6 million in cash, up front.
I want to translate that into plain English because in finance we casually call that a liquidity event.
Right, which sounds very clinical.
Very clinical.
Yeah.
But in human terms, finding $6 million in cash means draining every high-yield savings account you have, cashing out any stock portfolios, emptying your emergency fund, and maybe begging your family for help, all in one afternoon, just to get the keys.
And we haven't even mentioned the closing costs.
So there's more.
Oh, yeah. That $3 to $6 million is purely the deposit for the seller. You still have to pay the government taxes, the legal fees for your attorney, the valuation expenses to prove the home's worth to the bank, and the surveyor's fees.
Is the ultimate VIP club cover charge. I mean, it does not matter if you can easily afford the $50 drinks inside the club, meaning, you can easily afford the blended monthly mortgage payment. If you don't have the $10,000 cash cover charge to hand to the bouncer at the door, you are not getting into the club, period.
The cover charge analogy is spot on. And just to make this gauntlet even more challenging, once you finally get past the bouncer, pay the deposit, and sign the mortgage, you immediately run into a hidden monthly cost that is just skyrocketing right now.
Which is climate risk.
Exactly.
This was the most surprising part of the whole picture for me. We hear constantly about climate change, severe hurricanes, and unpredictable weather events. You would logically think that banks, who are obsessed with risk, would be terrified of a hurricane destroying their $30 million collateral.
You would think so.
But the data shows that external weather shocks haven't actually influenced mortgage interest rates at all over the past year. How is that possible? I mean, if the banks aren't charging for climate risk in the mortgage rate, how is the buyer feeling the pain of these storms?
To understand this, we have to parse out the difference between credit risk and physical risk. When you take out a mortgage, the commercial bank is primarily pricing your credit risk. They are asking, what is the likelihood that this specific human being will lose their job and default on this loan?
Which is why they care so much about your banking history and your income.
Exactly. They use the interest rate to manage human behavioral risk, but a bank has zero interest in managing the physical risk of the atmosphere. They don't want to calculate the odds of a Category 5 hurricane ripping the roof off the property.
So you just pass the buck entirely.
Exactly. They make it a mandatory condition of the mortgage that you, the homeowner, must carry comprehensive property insurance. The bank forces the physical risk onto the insurance companies.
Wow.
And the insurance companies are absolutely acutely pricing in the escalating realities of climate change.
So the bank washes its hands of the weather, but my wallet gets hammered anyway.
Right. As weather-related risks escalate globally and locally, the reinsurance markets panic and local insurance premiums skyrocket. Furthermore, weather risks cause massive construction delays and drive up the cost of rebuilding materials.
Because everything gets harder to source.
Exactly. So your mortgage rate might be fully insulated from a hurricane, but your monthly carrying cost is not. Suddenly, your carefully hacked, blended monthly mortgage payment is joined by an insurance premium that has doubled in the last few years.
It is a complete squeeze play. You are drained of all your liquidity to get over the deposit wall, and then your monthly budget is squeezed by mandatory, escalating insurance costs that the bank forces you to carry.
It's a lot to handle.
It really is.
Sure.
And when you lay all of this out, the 11% commercial rates, the $6 million cover charge at the door, the soaring insurance, the most logical, rational reaction for anyone listening is to say, I am out.
Just walk away.
Yeah. I'm going to sit on the sidelines, put my cash in a high-yield account, and wait for this whole market to cool off. I'll buy when rates drop or prices crash.
It is the most natural human instinct in a punishing environment. We retreat and wait for better weather. But if we look at the actual market dynamics happening on the ground right now, waiting might be the most dangerous financial trap a buyer can fall into.
Because the property values are absolutely not waiting for you.
Not at all.
If you look at the data coming out of Kingston, St. Andrew, parts of St. Catherine, and the major tourism corridors, property values are still edging up. They might not be exploding like they were during peak boom times, but they are steadily climbing.
And we have to unpack why they are climbing despite these massive financial hurdles for the local buyer. It really comes down to a brutal, undeniable imbalance of supply and demand.
Let's start with demand.
Right, let's look at demand first. You have intense population pressures, specifically urbanization. People are constantly moving toward the economic hubs for work. And crucially, you have sustained, aggressive interest from overseas buyers and the diaspora bringing foreign capital into the local market.
Okay, so demand is essentially a fire hose that never turns off.
Exactly.
But what about supply? I mean, why aren't builders just throwing up thousands of affordable homes to meet all this demand? If there are thousands of people who want a $25 million house, shouldn't developers be fighting each other to build them?
You would think so, but the math just doesn't work for the builders anymore. Developers are facing their own version of the inflation and climate squeeze.
Oh, right, the materials.
Exactly. The cost of raw materials, cement, steel, imported fixtures, has surged. Supply chains are still fractured. So if you are a developer, your margins are incredibly tight right now.
So they have to make a choice.
Right. You can either build 3 affordable homes for $25 million each and make a tiny, risky profit, or you can build 1 luxury townhouse for $80 million and secure a much fatter, safer margin.
They're protecting their margins the exact same way the commercial banks are protecting theirs.
Exactly. The supply of affordable housing is severely constrained because it is simply less profitable to build. So you have a constrained supply of homes, meeting a fire hose of local and international demand.
And in that environment, prices do not drop. They just grind upward.
Always.
So what does this actually mean for the buyer who decided to wait? Let's play this out. You wait 2 years. Maybe the commercial banks finally decide to pass on a tiny fraction of the central bank's rate cuts.
Okay, sure.
You save like 0.5% on your mortgage rate.
No.
But while you were waiting for that tiny discount on borrowing, that $30 million house you wanted just appreciated to $34 million because of those supply constraints.
And your 10 to 20% deposit requirement just went up proportionately. You waited for a discount and ended up paying a massive penalty.
That is brutal.
It is. And this brings us to a brilliant insight from Dean Jones, the founder of Jamaica Homes. He explicitly warns buyers against this trap. He points out people tend to focus on whether rates will go up or down. But in Jamaica, the bigger question is how you structure your purchase.
Structure over timing. That is the entire secret to surviving this.
Exactly.
You cannot control the Bank of Jamaica's policy rate. You certainly cannot control the global reinsurance market pricing your hurricane risk. And you can't force builders to construct cheaper homes. Trying to time those macroeconomic tectonic plates is just useless.
But you can control your microeconomy.
Right.
This raises an important question for all of us. How often are we paralyzed by trying to time the market perfectly? Because you can control aggressively saving for that VIP cover charge. You can control maximizing your NHT benefits. And you can control fiercely negotiating your commercial rate based on your banking relationships.
So Dean Jones is essentially saying that the winners in this market aren't the ones who wait for a miracle.
No, they are the ones who engineer a personalized structural solution using the tools actually available to them today.
Wow. Okay, let's take a breath and synthesize the journey we've just been on, because we have covered some serious ground today.
We really have.
We started by looking at the comforting illusion of the central bank's 5.5% policy rate, only to crash into the reality of commercial banks hoarding their cushions and charging everyday buyers 9 to 12%.
A huge reality check.
For sure. Then we explored the absolute lifesaver that is the NHT, and how blending that 0 to 5% public money with private lending is literally the only way most people can actually hack the monthly payments.
Right, and then we confronted the brutal upfront reality of multi-million-dollar deposit cover charges, compounded by the invisible squeeze of climate-driven insurance premiums that banks force you to carry.
And finally, we dismantled the wait-and-see trap. We realized that in a market where builders refuse to build affordable supply, but demand keeps pouring in from urbanization and overseas wealth, waiting for rates to drop just means watching the house you want slowly drift out of your financial reach.
As we wrap up this deep dive, I want to leave you with a final, somewhat provocative thought to mull over. It builds on the underlying currents we've discussed today.
Okay, let's hear it.
We know that urbanization, and specifically overseas buyers, are keeping demand red hot while affordable supply remains severely constrained. At the same time, we established that escalating climate risks are continuously driving up local insurance costs.
Which, as we said, directly attacks the local buyer's monthly budget.
Precisely. So if local carrying costs like insurance keep rising exponentially and global wealth continues to effortlessly prop up property prices in prime areas like Kingston and the tourism corridors, it begs a critical long-term question.
I'm listening.
Are we heading toward a future where owning a home in these prime Jamaican markets is determined less and less by local borrowing power and almost entirely dictated by access to international capital? Will the local professional, even with their blended NHT benefits and perfect banking relationships, simply be priced out of their own economic hubs by global financial forces?
That is a heavy but incredibly necessary question to sit with. And, it brings us right back to our opening thought. The dashboard gauges of average rates and central bank policies are completely disconnected from the reality flying by outside the window.
They really are.
You cannot navigate this market by looking at the pleasant headlines anymore. You have to look out the window, understand the mechanics of the engine, and brace for the actual terrain.
Absolutely.
Thank you so much for joining us on this deep dive. We hope you walk away feeling a little more equipped to read between the lines and a lot more prepared to build your own financial structure. Keep questioning the numbers, keep exploring these crucial economic intersections, and we will catch you on the next deep dive.